Hey everyone, and welcome. So, if you've ever thought accounting was just, sitting in some dusty back room crunching boring numbers, well, I'm here to completely flip that script for you today. We are going to look at accounting for what it truly is, the dynamic, powerful language of business. Whether you're an entrepreneur, an investor, or aiming for the C-suite, this is the language you absolutely have to master to understand how the corporate world actually operates. For today's explainer, we're looking at some fantastic source material straight from the Faculty of Accounting and Auditing over at the University of Economics and Law. What we're going to do is take their rigorous academic framework and pull it right into the real world. We're turning these foundational concepts into practical tools you can start using today. Okay, let's dive into this. Here is our roadmap. We're going to define the language of business, split it into financial and managerial accounting, and unlock the core equation. Then we'll cover everyday principles and methods, and wrap it all up with ethics, law, and tech. Let's start with Section 1, the language of business. Now, Vietnam's new Circular 99/2025 gives us this kind of dense legal definition. It basically says accounting is the process of collecting, processing, verifying, analyzing, and providing economic and financial info. But let's break that down, right? It's not just passive data entry. It is a super active, multi-step process. You grab the raw data, you process and verify it so it's rock solid, and then you analyze it. And why do we do all of this? Because the ultimate goal, the whole point of the shebang, is decision-making. Managers, investors, and the government, they all rely on this exact processed information to make their biggest moves. Moving right along to Section 2, financial versus managerial accounting. And this brilliantly illustrates the two different dialects of our business language. On the financial accounting side, think of that as your public face. It's for external users like investors, banks, and the tax authorities. Because it goes public, you absolutely have to play by strict, mandatory rules, and you're mostly looking in the rearview mirror at historical data. Now, contrast that with managerial accounting. This is highly classified, internal, eyes-only stuff for your board and department heads. It's super flexible, it focuses on future forecasts, and honestly, there's no mandatory format. It's all about pure internal strategy. Which brings us to Section 3, the core equation. Total assets equals liabilities plus owner's equity. Listen, if you take one thing away today, burn this into your memory. This is the absolute bedrock of accounting. And the golden rule here is perfect balance. Everything on the left side, what the company actually owns, its assets, literally has to perfectly match the right side, which is how they paid for those assets. So that's either through debt, which are your liabilities, or through the owner's own money, the equity. Let's put some real numbers to this to put it into perspective. Imagine a store sitting on exactly 500 million Vietnamese dong in total assets. But let's say they owe the bank and their suppliers 200 million dong. That's their liabilities. So 500 million minus 200 million, what's left? Exactly, 300 million dong. That is your owner's equity. The math itself is incredibly simple, but the implication is huge. Every single move a business makes has to keep this equation in perfect, flawless harmony. Let's zoom in on the asset side of that equation for a second. Accounting standards split these up based on time. So current assets, that's your short-term liquidity. We're talking things you can turn into cash in 1 year or less, your actual cash, inventory, or short-term receivables. Then you have non-current assets. These are your long game. Things held for more than a year, like massive tangible assets, think factories or heavy machinery, or intangible stuff like software licenses and patents. Time for a quick pop quiz based on our source material. Let's say a company buys warehouse management software for 80 million dong, and it has a 3-year useful life. What do you think? Is this a current or non-current asset? Well, since it gives you an economic benefit for 3 full years, which is well past that strict 1-year cutoff we just talked about, it is absolutely a non-current asset. An intangible fixed asset, to be precise. All right, Section 4, principles and methods. Let's see how this builds into the actual daily workflow. The accounting cycle is like a highly sequential assembly line. First, a transaction happens. Boom. Instantly, you prepare the source documents, like a receipt or an invoice. Then, you post that data to specific accounts to categorize it. Next, it gets officially entered into the ledgers, and finally, all that aggregated data flows right into preparing the financial statements. It's a chain, and you really can't skip a single link. Right at the heart of that cycle is double-entry bookkeeping. Let's demystify this with a case study for company ABC. They buy raw materials for 20 million dong and pay in cold hard cash. Because of those double entry rules, every single transaction hits at least 2 accounts. So we debit the raw materials account, showing a 20 million increase in assets, and we credit the cash account, showing a 20 million decrease. One asset goes up, another goes down by the exact same amount. The core equation, still perfectly balanced. Now, guiding all of these entries are 6 fundamental principles from the new Circular 99/2025 regulations. You've got accrual basis, which means recording things when they happen, not just when the cash actually changes hands. Going concern assumes the business isn't shutting down anytime soon. Historical cost means you record assets at their original purchase price. Consistency is just what it sounds like, sticking to your chosen methods. Prudence is all about being cautious with uncertainties. And materiality means focusing on the big ticket numbers that actually sway decisions. Okay, final section. Section 5, Ethics, Law, and Tech. Here is a real-world dilemma straight from our cases. Imagine it's year-end. Customer A owes your company 200 million dong, but word on the street is they're in severe financial trouble. Now, you haven't technically lost the money yet, but it's looking pretty bleak. So what do? Should the accountant step up and set up a provision for doubtful debts? This right here is exactly where accounting stops being about data entry and becomes entirely about professional judgment. And the answer is a massive yes. This is the prudence principle in action. Prudence legally dictates that you do not recognize assets or revenues when things are uncertain, and you absolutely must prepare for potential losses right away. By setting up that allowance for doubtful debts, you're protecting investors from seeing an overly rosy, unrealistic financial statement. It's not just a good idea, it is legally and ethically required. Let's raise the stakes even higher. Imagine you're in the hot seat. Your director pulls you aside and explicitly tells you to record 500 million dong in completely fake revenue. Why? Just to make the books look amazing so the bank will approve a massive loan. So, what do? The crucial point here is you say no. No way. You lean on the principle of integrity and the law on accounting. Professional ethics demand that you reflect the true nature of transactions. You literally cannot inflate revenues, and you cannot hide liabilities. Giving into that director isn't just bending the rules. It is straight up financial fraud, and it carries very real, severe legal consequences. Objectivity and integrity are your absolute best shields. And speaking of the law, we really need to talk about the huge shift coming to the workforce. Everything we're exploring today is grounded in Circular 99/2025, which goes into full effect on January 1, 2026, replacing the old 2014 rules. But the absolute game changer here is that this new circular is actively converging with international IFRS standards. So you aren't just learning some local rules anymore. You are learning a framework that puts you right on the global stage. And let's be real, you won't be applying these modern, global standards using a dusty paper ledger. The modern accounting world is completely digitized. You'll be using standalone software like MISA or FAST, massive ERP systems like SAP or Oracle, or cloud-based tools. And honestly, AI and robotic process automation are going to handle the heavy lifting of raw data entry anyway, which means your true value as an accountant, it's completely in your analytical skills and your unshakable ethical judgment. We have covered some serious ground today, from that core balancing equation to some really intense ethical hot seats. So, to wrap up, I want to leave you with a final provocative thought to really test what we've covered. Based on everything we just discussed, how would you distinguish between the prudence principle and the materiality principle using real business examples? Think about when you need to play it super cautious versus when you just need to focus on what actually moves the needle for decision makers. Chew on that, review your notes, and really master this language of business. Thanks so much for hanging out with me for this explainer, and keep learning.